Hello and good morning. My name is Gabriela Cruz, and I sit on the board of directors of the Global Digital Asset and Cryptocurrency Association. Today, we are pleased to welcome you for our event, Too Much or Not Enough, AML KYC in the Digital Asset Industry. Today's event will discuss a few key questions. How should businesses in the digital asset industry approach AML KYC? What tools and resources are available to facilitate compliance? What should forthcoming global DCA standards and guidance on the subject look like? This session will provide insight from four perspectives: a chief compliance officer, an AML KYC service provider, an AML KYC innovator, and a crypto asset audit and accounting services provider. Additionally, this session will seek to have opening comments and keynote speech from our colleague, Erik Kiefel. And with that, I'd like to introduce Erik Kiefel to the floor. Erik Kiefel is the Acting Office Director for the Strategic Policy in the Policy Division of Financial Crimes Enforcement Network, or FinCEN. Mr. Kiefel also leads FinCEN's Innovation Hours Program and Bank Secrecy Act Value Project, and co-leads FinCEN's BSA regulatory reform efforts. Previously at FinCEN, Mr. Kiefel performed the Executive Secretariat function for the Heads of Financial Unit, or FIU, Financial Action Task Force, or FATF, Forum, during the U.S. presidency of FATF. He has also led FinCEN's liaison team that works with counterpart FIUs, helping create a groundbreaking multilateral effort to share financial intelligence on foreign terrorist fighters. Mr. Kiefel also managed FinCEN's regulatory helpline and terrorist financing hotline. Before joining FinCEN, Mr. Kiefel was a project leader in the Division of Reserve Bank Operations and Payment Systems with the Board of Governors of the Federal Reserve System. There, he provided strategic, operational, and financial guidance and analysis on the Reserve Bank's operations, conducted research on the payment system, implemented laws and regulations related to the payment system, and helped develop policies to improve the U.S. payment system. In a previous life, Mr. Kiefel worked at MasterCard International, taught American government at Pepperdine University, and continues to teach financial statement analysis at the George Washington University today. He served as a Presidential Management Fellow with the Department of Commerce, Defense and State, and with the Agency for International Development, and officer of Senator Frank Murkowski, Republican Alaska. Mr. Kiefel received his BA in International Affairs from Claremont McKenna College, in National Security Policy from the Elliott School at the George Washington University, and an MBA in International Business from Grazio School of Business and Management at Pepperdine University. In his personal life, Erik is blessed with a wonderful wife, Laura, and two children who right now are very busy learning via Zoom classes. So I'll hand it over now to my colleague, Erik.
Thank you very much, Gabriella. That was a very kind introduction. And I'm very happy to be here with the Global Digital Asset and Cryptocurrency Association and its members. There is so much happening in this space of digital assets and cryptocurrency. Some good, some not so good. But it is so important for us to see that this association and its members are dedicated to establishing strong industry norms and codes of conduct to support and supplement existing and future legal and regulatory requirements in the US and globally. This is particularly the case in the area for which the Financial Crimes Enforcement Network, or FinCEN, is the lead US federal regulator. The Bank Secrecy Act, or BSA, and its anti-money laundering, countering the financing of terrorism requirements. The BSA is celebrating its 50th anniversary this year, just as of this last October. It was enacted due to a growing recognition at the time of the need to address money laundering and other illicit financial activity occurring through the US financial system, as well as globally. The idea was to better maintain a trail of information that law enforcement could use toward investigations, arrests, prosecutions of financial crimes offenses, whether it's using records, reporting from the institutions, or the identification of the customers and actors involved in the transactions and other activity. Back in the 1970s, that trail was generally in paper form, cash and checks. But like today, it was already making dramatic steps towards a more digital financial system with the advent of the automated clearinghouse, regional electronic funds transfer networks, and, oh my, automated teller machines. Amazingly, these systems still power much of our retail payments activity, along with the credit card networks. And that is why it is so important that the BSA can continue to be applied effectively to new financial services innovations. The BSA and its many amendments, including ones now pending final enactment in Congress, have become a powerful set of tools that U.S. authorities can use to protect the financial system and disrupt illicit financial actors. And when FinCEN issues new rules and provides guidance to aid in complying with the BSA, we apply a risk-based and tailored rulemaking approach and work to understand as completely as is possible the implications of ongoing innovation in the financial services sector for creating new opportunities of illicit activity, as well as how those innovations may help counter that activity. Our innovation initiative and joint statement on responsible AML CFT innovation from 2 years ago underpins our support for using innovation against illicit activity, not as its accelerant. Because of this approach, it has been crucial for FinCEN to ensure that the BSA applies to your industry. The United States was among the first jurisdictions to bring virtual currencies into AML reporting, record keeping, and due diligence requirements. In 2013, persons administering, exchanging, or using virtual currencies were brought under the existing definition of money transmitter. FinCEN has continued to respond to the innovation in your industry, most recently with additional guidance in May 2019. And for those of you who may also be regulated by the SEC, the CFTC, or a bank regulator, you have similar and in many cases more extensive BSA requirements. As you are all aware, FinCEN and the Federal Reserve Board jointly issued a notice of proposed rulemaking on October 27th to amend some of those BSA requirements, specifically the record keeping threshold and travel rule regulations. One of those key requirements, which are providing transparency into the US and global financial system today. Under the current record keeping and travel rule regulations, financial institutions must collect, retain, and transmit certain information related to transmittals of funds over $3,000, such as the name and address of the transmitter, any payment instructions received from the transmitter with the transmittal order, the identity of the recipient's financial institution, and, if it's provided, the name and address of the recipient. The proposed rule lowers the applicable threshold from $3,000 to $250 for transactions that begin or end outside the United States. The threshold for domestic transactions remains unchanged at $3,000. The proposed rule also further clarifies that those regulations apply to transactions above the applicable threshold involving convertible virtual currencies, or CVC, as well as transactions involving digital assets with legal tender status. And it does so by clarifying the meaning of money as used in certain defined terms in the BSA. As described in the NPRM, criminals are using smaller value transfers and CVC to facilitate terrorist financing, narcotics trafficking, and other illicit activities. Defining the term money to explicitly cover CVC and lowering these record-keeping thresholds for international transactions will help law enforcement and national security authorities better safeguard our financial system and protect our communities from harm. The proposed definitional changes in this NPRM are also consistent with existing FinCEN guidance, which makes clear that the regulations requiring the retention and transmittal of records related to transmittals of funds apply to transactions in CVC. Now, the comment period closed last month, and right now FinCEN and our partners at the Federal Reserve Board are reviewing nearly 3,000 comments. We appreciate the very thoughtful and comprehensive feedback that industry and members of the public have submitted in response to this NPRM, including probably many of you who are attending this event. What I also want to go into is how FinCEN is responding to innovation within your industry through our supervisory role, further clarifying the vital importance of compliance with your BSA requirements. In September, we explained our approach and standards in assessing and penalizing firms for lack of compliance with the BSA. Those standards apply to your industry. And we have used public enforcement actions to further stress the importance of compliance in building faith in innovative industries like yours. In October, FinCEN imposed a $60 million civil money penalty against Larry Dean Harmon for his role in operating the virtual currency mixing service Helix and a separate money services business, CoinNinja. From June 2014 through December 2017, Helix conducted over 1,225,000 transactions for its customers and was associated with virtual currency wallet addresses that sent or received over $311 million. FinCEN's investigation identified at least 356,000 Bitcoin transactions through Helix. Mr. Harmon ultimately failed to register his businesses as MSBs. He failed to implement an effective AML program, and he failed to file SARs. Through Helix, FinCEN's investigation was able to trace transactions with darknet marketplaces, child exploitation websites, fraud schemes, and other criminals. You do not want your industry to be associated with people like Larry Dean Harmon and the crimes he facilitated. You do not want to risk the hard-won recognition of being a regulated industry. And that brings me in closing to the value that compliance with your BSA obligations, including record keeping and reporting requirements, provides to the American public as well as your industry. Industry in general, in the financial services side, and particularly your industry, directly benefits from a well-designed regulatory framework in which to operate. And your industry has acknowledged this fact through its advocacy for regulation as a badge of responsible business activity and an imprimatur of being accepted into the mainstream of the financial system. Your association and its mission further underscores this reality. Compliance with the BSA also brings other tangible benefits for your industry. The ability to better manage your risks, identify and block bad actors, grow your revenue, and even attract new investment capital and partnerships. Finally, to return to my opening theme, your industry's compliance with BSA requirements, particularly those associated with reporting of suspicious activity, is crucial to government investigations and both public and private sector efforts to protect the U.S. national security and financial system and deter the misuse of financial institutions by criminals and bad actors. As a result, the American people are safer, the cost to criminals of doing business is higher, and our national security is better protected. Because at the end of the day, we all want the same thing: to be effective, to be efficient, to confront and address risk where it shows itself, to prioritize, to protect our national security, and to protect our families and communities from harm. I hope that you will all stay safe and well during this holiday season. Thank you again for this really wonderful opportunity to speak with you and about the important role that your industry must and will play in countering illicit financial activity. Thank you very much.
And thank you, Erik. We greatly appreciate your comments, and we look forward to an engaging discussion. I wanted to just make a short announcement that today, due to the size of the attendees that we have in the audience, we will be using the question and answer box, which is located at the bottom of your screen. If you click on that, you have the ability to answer and to provide questions in real time to panelists, who are then able to provide you written responses. Additionally, during the course of the event, the moderator will be reflecting on the different comments and questions posed, and will be incorporating those into the ongoing discussion. At this time, I would like to call to the floor my friend and colleague, Tony Pettipies. Tony presently sits on the board of the Global Digital Asset and Cryptocurrency Association, as well as chairing our Public Policy and Regulation Committee. Tony has over 30 years experience in the finance industry and has leadership roles in electronic trading across global markets, including the design and development of trading platform software, exchange protocols, and infrastructure. Presently, Tony serves as chairman of Grip Investments, a boutique investment bank regulated by the Dubai Financial Services Authority and established within the Dubai International Financial Center. Tony?
Let me unmute myself. It's the easiest thing to do. I'd just like to add one thing to that, we in Dubai, where the bank is, we sit in the DIFC building. We're regulated by the DIFC building, and we partner with the DIFC for AML KYC. That's been a tremendous advantage for us, as we're now compliant in about 120 countries around the world. everywhere except North Korea, India, and Saskatchewan. So I'm not going to linger, but I'd like to introduce the moderator, Amit Sharma. And Amit is the founder and CEO of FinClusive. Has been engaged in many aspects of the financial industry for many years. He is a leader in regulatory compliance and development. FinClusive is a hybrid RegTech company that's dedicated to financial inclusion by providing a full stack of financial crimes compliance platform with digital access to accounts and multi-form payments. Prior to FinClusive, Amit worked in both the public and private sector, including with Empowerment Capital, Command Global Services, Mitsubishi, and at the U.S. Treasury Department. First at the inception of the Office of Terrorism, and later as COS of the Deputy Secretary and Advisory to Treasury Senior Secretary Henry Paulson. Amit is leading the global consortium providing industry and regulatory guidance and best practices related to FinClusive finance, and in particular application to the non-bank and virtual asset domain. And I have read his 400 rules, and it's a very good read. Amit, over to you.
Thank you very much for that kind intro, and anyone that's going to take pleasure about reading a document with 400 rules and guidance and best practices is a fan of, I'm a fan of, and just shows the geekiness of this space. Thank you very much to the association for having us. We have a fantastic panel today, and I want to thank Erik for giving some upfront comments on the perspective from the Treasury Department and FinCEN in particular. As folks heard too, I'm an alum of the U.S. Treasury Department, work very closely with them in an ongoing basis, in my role at FinClusive. And it's really, really important that the industry and the regulatory community, the law enforcement community, the policymaking community continue to work hand in glove in this area, especially given the exponential growth of alternative financial services and financial technologies. So a couple quick upfront comments, and I will introduce my esteemed panel, which you will see the diverse nature and backgrounds that they have to really address some of the concerns, challenges, as well as opportunities that virtual asset service providers, the cryptocurrency sector broadly, and these new and alternative financial ecosystems and technologies can really afford. A couple important trends to just kind of set the stage, and before I invite our colleagues up. One is, as Erik pointed out, as folks know, the exponential growth in these alternative non-bank financial technologies, financial services, products and services is a boon. They're increasingly cross-border in nature. They're not jurisdictionally bound, and they're able to bring more and more organizations, people into financial services that have been traditionally either blocked, underserved, excluded, or de-risked or pushed out of traditional banking services. That's a tremendous opportunity. At the same time, as Erik points out, and as several of us have within our backgrounds, the importance of financial system integrity, not only for consumer protection, business protection, privacy, security, but for the system to enable licit and legitimate actors and be just that much riskier and costlier for illegitimate players to take advantage and exploit the system. However, the third trend, as we've seen really throughout the course of the last number of decades, is compliance can be challenging, can be hard, can be expensive. And a number of institutions rightly have to make that cost-benefit analysis of how do I approach risk compliance, regulatory compliance, not only in a risk-based approached way, as Erik and the regulators talked about, but how do we do so in a way that also takes advantage of these new technologies and new operating protocols to get more folks in the system? So while compliance remains challenging, often expensive, and often inefficient, there are that many more technology capabilities and applications. And in fact, I would argue that even in the virtual asset and cryptocurrency domain, the very operating protocols and mechanics may lend some opportunities to enhance financial risk, transparency, and compliance while bringing more folks in the system. It's certainly not anathema to folks here in the panel and for our participants that we have billions of people that continue to be underserved or excluded from the financial system, and hundreds of millions of organizations. And this year has proven and shown that with the pandemic, that many that have been excluded from the system are really disenfranchised from joining the formal economy. And in whether it's jurisdictions, whether it's frontier and emerging markets, whether it's certain types of customers like low, moderate income, those that rely on remittances, nonprofits, and others that have traditionally been underserved, these new technology applications provide real promise. And we have to ensure that certain financial sector integrity goals and challenges are met at the same time. So therein lies a bit of the balance of inclusion, compliance, risk, and the application of new technologies. So excited about bringing the panel on. And with those contextual thoughts, let me give a couple quick intros of our panel and ask you each in turn to take a couple minutes to talk from your perspective of these challenges and from where you sit. Our first panelist is Marian Todd. She has over 25 years of experience in credit, operational and AML risk management with esteemed companies like Bank of America and ABN AMRO. She's currently the head of commercial banking at BMO Harris Bank. She spends a number of her hours and time focused in the AML compliance space and is getting increasingly engaged with the virtual asset and cryptocurrency space from her position at the bank. Second, we have Jesse Spiro. He is the current head of policy and regulatory affairs at Chainalysis. Obviously, Chainalysis is a known company that is very well versed in blockchain analytics and cryptocurrency analytics. He was previously the head of threat finance and emerging risks at Thomson Reuters. He's done a lot of work and continues to do work with the Digital Chamber, Anti-Money Laundering Group, the National Security Alliance Threat Finance Task Force, and others, and brings really valuable insight from an investigative and analytics perspective. And our third panelist is Noah Buxton. He is the director of the blockchain practices at Armanino LLP. He's got a background in accounting and brings a very interesting perspective on how the applications of blockchain technology, and in particular within the virtual asset and cryptocurrency space, play within the space, not only from a risk and compliance perspective, but also from an accounting perspective. So with that in mind, if I can ask in that order to take a couple, 3 minutes from your perspectives on that intersection of compliance, this new tech, and what are the risk and opportunities you see with respect to virtual asset and cryptocurrency growth in this space? Let me start with Marian.
Thank you, Amit. First, let me make a brief correction. You said head of commercial banking. I'm head of AML risk management within commercial banking. I don't want to assume a position that I don't have. It's a pleasure to be here and to be able to speak to you all. I have to give the usual disclaimer that my views are my own and don't necessarily represent those of the bank that I currently work for. So taking off on what both Erik and Amit said, I think the regulatory environment in the US has allowed us to, as a financial institution, to develop a risk approach to virtual currency, blockchain-based, cryptocurrency-based businesses much quicker than in some other regions, some other countries in the world. I started looking at this type of company from an AML risk perspective back in 2016. And that was following on the heels of some conflicting court decisions, some of which said Bitcoin is a form of tender, a form of currency, others which said it was a commodity. And so there was a bit of a conflict as to how to treat this type of company from a regulatory perspective. And we didn't have a framework within which to place it. So we had to develop our own approach. That, coupled with the fact that so many of the entrepreneurs that started firms in this space and were brave to do so, given the lack of regulatory framework, so many of these firms had a new approach that didn't quite fit the mold. I think it was a watershed, at least from our perspective, when FinCEN said, okay, the transfer of virtual currency to fiat or virtual currency to virtual currency is going to be looked at as a money transmission. And then we could say, okay, this is going to look like an MSB, needs to be registered as an MSB, at least for activity within the US. And that gave us an easy place to put the kind of assessment that we needed to do on this type of company. Now, that said, the point that you made about inclusion to the underserved markets and the disenfranchised and so forth, I feel as though there's an inherent rub between these jurisdictions' attempts to regulate this type of a business as they would a traditional financial business, And the spirit of the industry as a whole, distributed ledger technology and cryptocurrency transfers to be borderless and without the backing of a central bank, to have that kind of universal application and accessibility makes them inherently more difficult to pin down and to put in a box and to get the kind of information that you want to get as a financial institution in order to ensure that you're covering your exposure, your risk exposure. So I think the fluid nature of the regulatory approach to this from jurisdiction to jurisdiction makes it a very interesting space to approach, even as I do from the intersection between the traditional financial markets and this new developing industry. So it's I'm always interested to see a new customer come to us, because as I said, they all seem to be a new hybrid. They're always innovatively structured and put together, and that's gotten more consistent over the past few years, but still it's a very exciting place to focus my attention on. So, Amit, back to you.
Thank you, Marion. Thank you very much, Marion, for those comments. And it's interesting, two takeaways from those comments, right? One being the issue of the classification of virtual asset service providers, at least in the catch-all here in the US as a non-bank MSB. One question is that appropriate, from the standpoint of the operational aspects of cryptocurrencies and virtual assets? And then the second is, as you rightly point out from the bank perspective, seeing a lot of different models, not only in terms of the business constructs themselves, but also the operation. So if you could keep those two couple points in mind as we circle back, I would love to expand a little bit more on that. Jesse, if I could turn to you secondly, from your perspective at Chainalysis, and also because you've just been engaged with the regulatory policy community for some time, if you could offer a couple upfront comments.
Sure. I mean, I'll try and be concise. This is a broad question. There's so much that you could bring into this conversation. I think when you talk about the opportunities, off the top of my head, the frictionless payments, the capability of financial inclusion. For us, the transparency, the traceability, the provenance that the blockchain provides in relation to payments, these are all amazing opportunities, and this new technology can provide a lot of value to financial services as a whole. When you pivot to the risks, the first thing that I would say that I think is important is I come from traditional financial services, from AML CFT. One of the things that was very attractive to me was the fact that you had this traceability and transparency when it comes to virtual assets. And as I headed up emerging risks for Thomson Reuters and Refinitiv in my previous role, we were looking into kind of the emerging risks within the landscape. And we saw virtual assets as potentially being inherently risky because of a lot of the press and the conversations that were being had with global law enforcement and regulators. But as I dove into the space itself and I learned more and identified Chainalysis, for example, and realized that you could conduct real-time transaction monitoring, that you could follow the money in a way that you cannot do in traditional financial services. One of the good analogies I like to make is that when somebody brings a fiat dollar and provides it for a transaction, it's very difficult to follow every cent of that dollar, right, in relation to the transaction history. But with cryptocurrencies, you can do that. It's extremely powerful. When we talk about the risks, however, there's a couple that I do think are important to point out. The first is in relation to the way in which this technology is evolving and the velocity. The train has already left the station. When we talk about things like DeFi and the next iterations that have come from what we saw early on with Bitcoin, regulation is meant to be flexible, right? It's meant to be flexible with technology, but I don't think anybody could have accounted for the way in which this technology was going to evolve and how quickly that was going to happen. And so I do think regulatory reform eventually is going to happen, because to maintain financial integrity, you have to find a way to, one, control an ecosystem, right? While not hindering innovation. And so I think there's a real rub there. Another one that's important is the issue in relation to KYC, and we're going to be talking about that today. Within the controlled environment in this ecosystem, in an ideal world, when illicit activity happens, investigators could use blockchain forensics and could follow the flow of funds to an exchange. They could then subpoena who those individuals are behind those transactions and then effectively prosecute successfully. But we don't have that universally across the industry. And I know we're going to dive more into the issues around KYC when it comes to financial inclusion, the lack of access to that kind of documentation in some developing economies and these issues. But it is something that is very important in this space because we do not have universal regulation that has been applied yet. And so then you have regulatory arbitrage, you have some of these gaps, and that's what's being abused currently. I'll yield my time because I can go on and on, but I'm really looking forward to this conversation.
Thank you, Jesse, for those comments. Very insightful. And yes, we'll be doing a bit more deeper dive in a couple of those more granular elements as well. Noah, can I turn to you for some opening comments?
Sure, Amit. Yeah, these are three incredibly hard acts to follow. I'd say that. So in my daily practice, I do a number of different things, but one of them is to work with startup and sort of, I guess you could say, maybe larger or mid-market type companies on compliance. And one of the pieces of that is AML. So the perspective I come from is a little bit different, not policy making or regulation per se, but really trying to help businesses succeed and navigate. I think as others have sort of mentioned, that's a thicket right now. It's a difficult path for a startup company right now to navigate, both sort of conceptually, figuring out where to go strategically, what makes sense, and then also simply financially. These burdens can mount really fast. It's full employment for CPAs and accountants over here, attorneys, of course, full employment for them as well on these issues. So I thought one of the things I could say at the top would be, some practical guidance, some things that I see in the field, less at sort of the BSA or federal level, more down to sort of the state patchwork and what you're sort of looking at. So let's take the simple money service business case. You're doing effectively a money transmission activity, digital asset or crypto based. What do you need to do? I would say one thing would be helpful early on is to just kind of think about whether your go-to-market strategy is aligned with your compliance strategy. There's a lot of go-to-market strategy. There's a lot of thought about innovation and disruption, and compliance oftentimes seems to be an afterthought. And I think that aligning those things early can really set expectations for your investors, your partners, and give you help you set a good path ahead. I think finding expert partners is very, very important. I have to be honest, we as accountants tend to be brought in towards the end of the process, right? We've worked with the lawyers for a year. But they say we need an audit, right? We need a financial statement audit. We got to file that with the regulator. We also need this thing called IT and security audit or a cybersecurity audit. What is that? Where do we start? That's going to put you very far behind if you take that approach. So you definitely need to work with your attorneys to get the legal advice, the formation, for them to, not in a disparaging way, but push the paper, right? And give you the right legal advice. Accountants are very well suited to do sort of implementation type work. Accountants and consultants, right, can help you do hands-on work, help you understand what are internal controls, given the nature of my business and my operations, what are the real AML KYC risks, for instance? I'm talking sort of generally around AML, but also into, sort of IT, internal control or financial reporting, which are also, they're very, very important. So I think that would be one thing. Get experts in early. It's never really too early to even have initial conversations with people. And then you need to start to navigate these audit requirements and this state patchwork, right? You need to have a strategy around where you're going to market. I tend to work, I work with global companies, but a lot of them, I'd say 75% are probably US. So I have sort of a US centric view on this. And to do that, there's a multi-state licensing system, which is helpful. That gets you into, think it's about 28 states. Someone on the call probably knows better than I do. And that's a good single point. But there might be a strategy to say, take some of the toughest states first. If you can comply to the highest bar, you're setting yourself in a really good position to be compliant in other states and make those filings easy. I could go on, but I want to take up too much air here. So I guess at the end, I would say, for this sort of opening salvo around what you can do, or what would be helpful, I think, from a regulatory perspective would probably be more consistency, because the truth is, even if you've got audited financial statements and you've done some sort of IT and controls review and you've drafted and implemented an AML KYC policy, even then, exactly what the regulator is going to review, what they're going to ask for in terms of documentation, what types of questions you get back is not standard at all. And I hear from clients all the time, we work with clients that really have trouble navigating that, right? Because it's speaking different languages to different regulators. In some ways, they're asking for different things. So.
Great, thank you, Noah. I appreciate that overview. And you rightly point out a couple of challenges that the sector faces broadly, right? From the standing up of a company as a startup, do you have the resources, manpower, and ability to have the kind of support structures that you need, and then the piecemeal efforts to ensure that you have the regulatory certifications and licenses in place. Let's take each one of these, and taking off of a couple of things that Marion and Jesse also said. Marion, let's start with you. You're in the bank. Cryptocurrency company A, virtual asset service provider B, exchange, cryptocurrency exchange C is coming to the bank wanting to establish a relationship. If we take a couple of points that Erik had pointed out on a risk-based approach that institutions need to take, and as you kind of evaluate these organizations coming in, they need many different types of services, from just a plain vanilla business and operating account to maybe clearing and settlement services to payments, in and out of a product that is a little less well known. And to take Jesse's right point, I think the cryptocurrency or virtual asset space, has been an unfortunate victim of a lot of poor press in the last number of years. Some totally warranted. There's been some illicit activity out there. It hasn't been completely completely above board, but there are so many really good applications, and I would argue the majority are trying to do the right thing. So as you bring in those entities saying, I now need to have that bridge into the fiat world and the traditional banking, can you talk a little bit about your evaluative process in working with those companies in that range?
Sure, thanks. When we have a new prospective customer come to us for evaluation, the first thing that we do is consider what their business model is and try and confirm what regulatory responsibilities they have. All of these firms have customers, and to the extent that, as you say, if they need an operating account, that's one level of risk. If they're opening other accounts or passing the settlement of transactions through the account, then there's an element of third-party risk. And so we really need to dive in and say, what controls do you have in place as a prospective customer that are going to make me comfortable with that third-party risk? So depending on their regulatory responsibilities and the types of transactions they're processing, because we've looked at everything from a broker dealer to a settlement partner, some entities, as I said, each one seems to be different. So there are some companies that have multiple different functions and aspects of the business inside one legal entity. And then there are others that establish a group of legal entities, each with a specific focus. So once we've determined how we're going to bucket them, if you will, and know what their regulatory responsibilities are, then it's a question of looking at their AML program, looking at their controls, and really making sure that they understand the risk that their own business represents to them, because then they will have adequately put controls in place that can make us comfortable as a bank.
Excellent, thanks for that. Noah, as an individual in a firm that is often engaged by these companies to say, help me please, run through that not only licensing and certification process, depending on the kind of which definitional box I reside, but I imagine a lot of that inquiry also is help me navigate the processes to establish those real relationships with the banking side. And just curious too, just I know the majority of the client base is largely US based, but so much of this is cross-border. So they're trying to engage with institutions in multiple jurisdictions that not only qualify or classify digital assets differently, but then the regulatory footprint or obligations differ too. And so how do you kind of change your hats for that kind of questioning?
Yeah, that's a good one. I agree. Yes, you have to be able to navigate and speak to sort of different standards, right? So you working with a potential banking partner, for instance, they're going to ask you about your compliance program, sort of like Marianne was saying. So being able to speak that language and sort of have the right response is really important. Saying we're doing something that transcends traditional banking and it's totally different, don't worry about it, is obviously not the right answer. Something even in between, saying, look, we are hosted on AWS and so we've got all the right things in place. That's not a great answer either, because that's not true internal control. But being able to speak to how you think about governance as an organization. Even a small organization can have governance, right? You can think about senior leadership and the way you run cadence of meetings, the way you formalize policies around, again, the way you govern your organization, right? The way you think about risk, the way you think about fraud, the way you think about reporting, and being able to speak to, again, potential financial partners as well as regulators, just in that general sort of elevated tone around, and use their language, again, internal control and policy and governance. In terms of the international stuff, incredibly difficult problem. I agree. And there's no silver bullet for that. But hopefully being able to have a demonstrable compliance program, including ML, that you can really talk about and that is really implemented. A simple policy on paper is not enough. It has to truly be implemented. Is probably the best start to that.
Excellent. Thanks very much. So it's really just coming to the table with the appropriate tools.
Marianne wanted to correct me on something. Sorry, Amit. I see Marianne wanted to correct me.
Yeah, go ahead.
I wasn't going to correct you. Sorry.
No, I'm just kidding.
I just wanted to add that when you're approaching a traditional financial institution, particularly when you're conducting the majority of your business on a blockchain, be aware that that is completely opaque to your financial institution. So the majority of your business, or nearly the totality of your business, is in a space that we have no transparency to as a bank. We expect you to. And so that's where the deep dive into the program and wanting to look at those individual controls comes.
Well, that's a good segue. I'd like to bring Jesse in on that. Yeah, you're jumping at the chance of that. Yeah, I'd love your
I actually wanted to hop into that point in the banking issue more generally. For a long time, what we saw was that banks had essentially just de-risked the crypto space. You still see that in some markets. They're starting to dip their toes in, but generally it was just something they didn't want to touch, right? And I think that also had an unintended consequence, which really drove up the OTC market, where we've seen a lot of illicit activity out of places like APAC, because all of the firms that are in the crypto space couldn't gain access to banking, right? And they needed liquidity, which really drove that service itself and created some of its own problems. But the good news is, I mean, for a long time, we've been engaging with financial institutions. We put out regular reports to try and educate. And if you look at the crime within the ecosystem, crypto crime, it is significantly down this year, but that is within the controlled environment. When I say controlled environment, I mean within those entities, right, that have compliance programs that are regulated, which is the kind of activity that we track generally, right? Those that are trying to, initiate best practices. But on the point of visibility, as we have started working with more financial institutions, and as they're building their capacity and knowledge, you can see everything in relation to the blockchain activity that a service provider, that an exchange, that a crypto business is conducting. And, the visibility there is, again, really unprecedented. And so that market is growing as those relationships continue to grow.
Sure. And I totally agree. And one of our questions, one of our points would be, when dealing with a business that is acting on the blockchain, we expect them to have that type of a monitoring system in place so that we're comfortable with their controls. But the problem enters into it if we have a system to look into our customers' transactions and we're not active in them ourselves. With that information then comes a responsibility to monitor it. And that can be, there are levels of tracking the information on the blockchain, but if we're not seeing all that activity come through the account, then it's, I don't want a record of all of my customers' transactions that are occurring elsewhere if I'm then responsible to monitor those and file SARs on them, et cetera, et cetera, et cetera. Do you see what I mean?
I do. It doesn't necessarily track, but in relation to the kind of activity that's collected and the fact that there's the pseudo anonymity connected
right
to that activity. So the onus wouldn't be on you necessarily, but I do understand that there's a control around what you're trying to do and the risk-based approach that you're taking in relation.
Right. I just feel it's more important for our customers to have that than necessarily for us to have that breadth of insight.
Yeah, from the professional services perspective, when we talk to any company in this space that's doing money transmission, digital asset, I mean, it's almost I don't think you can get around having a blockchain analytics system now. That used to be sort of a, depending on volume, depending on complexity, things like that. Now I feel like it's almost an absolute. So again, full employment for Jesse now too, but yeah, I think that second point you bring up is very interesting from my perspective. If I was advising a client, it's really about, so to Marion, right? Can you take to the bank? Can you take a description of your actual transaction flows? Can you take a description of your typical customer profile, right? Those would be two good things to start with, that could really, again, sort of demonstrate, make it understandable to your banking partners. And that documentation is also really good for regulatory purposes too. When they can see that you can put these things on paper, you will stand out, trust me, because it's not a universal capability.
Mm-hmm.
That's great. Thanks, Noel, for that additional color. And in fact, it reminds me of something Jesse said, and we've got, in fact, a question referencing this. Obviously, different jurisdictions have different methodologies for that oversight, those requirements. And as a result, certain jurisdictions a little easier to get set up and running in to have a bit more scrutiny or less scrutiny based on the regulatory oversight. One of the questions that came up is that, in certain jurisdictions, in particular Asia, with, for example, OTC desks that may not be or may not be acting as compliantly, are from versus other jurisdictions, maybe because of oversight controls lacking and the like, or enforcement mechanisms. Jesse, from an analytics perspective, because you have global coverage at Chainalysis, are you seeing any particular trends vis-a-vis the compliance and or transparency tools that are being put in place at various exchanges, whether they be full exchanges, OTC desks, brokers, and the like, and or just from a value transfer perspective in and out of different networks? Any thoughts or guidance or color there?
Yeah, a couple of things. I'll start by saying that just because an organization has the tools, it doesn't necessarily mean they apply them, right? They have built out their own risk assessment, right? And their own risk appetite. And so that's the first thing that I'll say. More broadly, when I mentioned APAC, there is a caveat that I should say, which is that in APAC, you have a huge virtual asset crypto market, and you have certain jurisdictions within APAC that have been building out fantastic regulatory regimes, like Japan, like Singapore, like slowly we're starting to see development in Korea, for example, as well. However, more broadly, when it comes to OTCs, their functionality and some of their value proposition provides inherent risk. They provide more secrecy for their clients, right? They provide that peer-to-peer activity. Most of them, or many of them, I should say, I don't want to loop them all in together. Many of them do not have compliance controls, KYC, et cetera, source of wealth checks. They're not looking to do that, right? And those OTCs are nested within much larger exchanges, having access directly to these larger exchanges. In our report that we put out last year, we identified something called the Rogue 100, which were OTCs, 100 of them, where we saw the majority of the illicit activity in the cryptocurrency ecosystem flowing through. And by way of that, then flowing through to exchanges. So if we're talking about have we seen a real shift in that, we still see a lot of the illicit activity flowing through those OTCs and flowing through those exchanges in this year, in 2020, from the market research that we've been doing. Some of the kinds of typologies are changing. So in relation to the illicit activity that we're seeing, last year was the year for scams and fraud, right? Which ties into issues of consumer protection. This year, we're seeing a huge jump, 600% in ransomware, which makes sense, right? In relation to, digitalization that has occurred as a result of the COVID pandemic, ransomware has just been rapidly scaling. So, those are my points initially. I would say generally, as a result of FATF implementing the virtual asset recommendations in 2019, in the summer of 2019, I think some expected you were going to have a real domino effect of implementation of regulation globally. You were going to have this kind of global cohesive regulatory regime as a result. And eventually, I do think we get there. And jurisdictions are starting to adopt closely those recommendations that have been released. The issue is that it is a slow-moving dinosaur, if you will. It's a process that is taking some jurisdictions much longer than others in relation to building out the regime, supervision, et cetera. And so you do have regulatory arbitrage that is still occurring in some places, and then it makes sense that the illicit activity is funneling into those jurisdictions, right?
Very, very helpful. Related, but a slight pivot, and I'm curious about the panelists' view on this. And this also takes from points both Noah and Jesse had said earlier. There is a perception challenge, right, that the virtual asset and cryptocurrency sector faces. And I just take myself back to, early Treasury days, post 9/11, when you look at different technologies, products, and services, right back then, we were worried about prepaid cards and gift cards from an illicit finance and fraud perspective. We were worried about alternative value transfer systems, Hawala, Hundi, and other forms of quote unquote unregulated money services and money transfer operations, right? And bringing more and more kind of into the fold. And certainly we've seen a similar thematic in the virtual asset space. And yet we see tremendous growth, tremendous application, use cases that help with the inclusion side. We'll jump into the inclusion side in a second. Noah, you help these companies. Marion, you evaluate these companies. Jesse, you analyze the transaction flow and other activities associated with these companies. How do we look at overturning a little of the perception of risk problem? And I will just say, just from my perspective, having been, in this space in financial services and compliance for the last 20 years, given the trends like I just described, it's always a fun challenge when something new and innovative comes in, that then regulators have to say, okay, how do I ensure consumer protection, prudential rules, system integrity, right? And if I have to overlay that very often, it's taking the traditional regulatory compliance toolkit and then applying it into that space. And the virtual asset and cryptocurrency space, because of its operational architecture, because of the manner in which it operates cross-border, because of the use of the blockchain and the characteristics and attributes of distributed ledger technology broadly, any thoughts on how the sector can improve its standing, if you will, and showcase positive use cases that, again, Noah, to the point earlier, if I'm a startup and which FinClusive is, if I'm a startup and I'm walking either into a bank or into a regulator saying, we got a great way to solve X problem, and you have to overcome both, here's my business model and operating premise, but I also have to overcome the perception challenge. Any thoughts and guidance there? And why don't I start quickly with Mary, and just kind of when you see these guys come in, and then I'll ask the others to comment too.
I think we have been, well, I've been fighting that battle. That's why I said these are my opinions, not necessarily the bank's. I early on decided to look, as Jesse mentioned, the trackability of a transaction, the immutable qualities of a blockchain. It's cash plus. So I feel like you have to look at the risk as no different than cash in terms of 2 or 3 hops away of a transaction, there could be a connection to something illicit, but by the time it reaches your customer, is transferred to fiat, reaches your bank, it's removed from that connection. I've seen the customers that we've talked to go above and beyond in terms of making sure that they're regulated, making sure they've got the legal opinions, the compliance framework in place. A lot of them have applied for the NYDFS BIT license, even if they didn't necessarily have to, just because of the comfort that that provided, because it was known to be a rigorous review process. And so they would go ahead and establish some operations in New York just to get that additional regulatory nod, so that they can then come to a bank or come to other business partners or investors and say, look, we've done A through J and we are as compliant can be. I think that's part of it. Unfortunately, and I admire the fact that they've gone to those lengths. Unfortunately, I think the only other thing is time. There has to be, it's still the new bright shiny thing. And as you mentioned, I think Amit, most of the press that you remember is the bad stuff. It's the Silk Road, it's the criminal cases, the DOJ orders and so forth. It's not the number of successful, honest businesses that are in place conducting business every day. So I think to reach that cultural tipping point where it becomes as acceptable and is seen as safe is just going to take more time.
Thank you. Jesse, you have a couple comments on that as well?
I do. So outside, to Marion's point, outside of showing that there is an effective compliance program with policies, procedures, training, et cetera in place, right? And showing that the risk-based approach is being applied and enterprise risk management is occurring as well. Outside of those things, transaction monitoring for us is this game changer that you can see, and you can do everything from behavioral analysis to other kinds of analysis that you can't do in traditional financial services. So on the point of press, what I would add is there has been legacy negative press in the crypto space. If you look this year at some of the press, what I would encourage would be to cite the DOJ press releases where, Chainalysis supported the seizure and success of over 1.5 billion with a B US dollars worth of cryptocurrency cases, spanning a very wide range of illicit activity. And that's because this works, right? Working with the exchanges that are conducting proper KYC, obtaining those kinds of records, law enforcement has been able to follow that linear process that I mentioned and catch these bad guys in an unprecedented way. You don't see that in traditional financial services. It's not because there's more illicit activity in crypto. We're seeing that downward trend, and we can verify that with the on-chain data. It's not talking points for us, right? You can actually see it if you're following the flow of funds and you're following the blockchains. So I would encourage to highlight those kinds of success stories because you've seen them at an unprecedented rate this year. And in the U.S., you have probably, let's argue, the best regulatory regime. FinCEN has been regulating the space the longest. They're putting out regular advisories right on the space and guidance regularly. They've built out a team specifically around, VC enforcement. They've taken this proactive approach. You're seeing the fruits of that labor, right? So at least domestically, when we're talking about the domestic market, I think you can make that case. And that's something that we are seeing, even though you may not see it in the press, that is replicated around the globe. I can't count on many hands the number of successful cases that we have supported around the globe in the last year. So.
Thanks for that. And we see something similar. Like I said, just in the last 20 years of my involvement in and around this space and crossing over between financial services, both on the traditional side, the new technology side, fintech, crypto, and then with the regulatory and policy side, I will say that I think the most proactive work I have seen with new and emerging sectors in that last 20 years has really been in the crypto and virtual asset space. The Global DCA is a testament to that. The work that we're trying to push with a global best practices and guidance framework for crypto and virtual assets in the AML obligations that they have, work of Global Digital Finance, the Digital Chamber, and others. And in some ways, very, very pleased to see that proactive work. In an effort to be kind of equal opportunity antagonizer, though, which I like to be, regardless of the press and the operating aspects, you point out some fantastic examples of where and how the technology itself lends directly, not indirectly, but directly to improving the efficacy and capabilities of law enforcement and regulatory oversight. And yet, I mean, I'm not sure if folks on the panel, that are joining us here today, how many folks were aware the DOJ put out its cryptocurrency report, about a month ago, peppered with a number of vulnerabilities in the sector. And again, they're charged with looking at the kind of fringes and the vulnerabilities, right? There was also the FATF red flags indicators report that came out this summer, and arguably there were maybe one or two attributes that were unique to crypto, but many of the methodologies associated with those quote unquote red flags we see in the traditional fiat markets, right? So part of this is really saying, what are inherent risks in the financial services space, regardless of form or type? And then how do we understand and look at technologies that either exacerbate that risk and, importantly, bring down those risks inherently because of their operations, just like you, Jesse, had rightly pointed out. So I would love a couple thoughts from the folks there, because at the end of the day, the natural transition is, how do I then illustrate those with the appropriate AML processes? How do I look at those anti-fraud and transaction monitoring controls? How do I look at KYC and KYB in a more effective way? One of the questions that has come up from the broader group is, what are the kind of the best KYC solutions when you think about the nature, as Marion, you describe on operations, people involved and the like, in the transparency. But if I could just throw that broader question out there, how do we achieve that balance? And are there any solutions in the marketplace, specific in the regulatory technology and compliance area, that you would recommend in the sector? Marion, you want to start up?
Sure, if I could unmute myself. I hesitate to recommend a particular system because I know we have people joining from multiple jurisdictions. There are multiple vendors of KYC systems, and I would anticipate that a smaller firm wouldn't want to build its own proprietary software, would want to go and look at what's available. And there are some, I will say, there are some that are best suited for smaller operations, and others that are best suited to a much larger, more complex organization. So a little bit of research on the internet, you should be able to find a few of the vendors that are available. And I would say do a review of several, and then in consultation with your compliance folks or with your attorney or with your consultant, however you're building your business, take a look at what they have to offer and make sure you pick one that is suited for your business. You don't want to get something that's overbuilt, that you're paying too much for and not really using the capabilities of. And also you don't want to get something that's not going to do the job and leave you with vulnerabilities or gaps. I will say that looking at these businesses as we do, coming from a traditional financial institution standpoint, I agree with what Amit said. A lot of the typologies are the same. A criminal is a criminal and is going to be looking to exploit the dark areas of the financial network where they can slide something through unnoticed. So we look at a business and would expect, for example, an exchange that has a threshold below which they're not collecting any KYC information. And that's an individual risk-based business decision that each business can make. But in that case, then, do you have, similar to what an MSB would have, do you have software that's going to aggregate transactions for the same individual, or have some way, if you see, say, $200 transactions and they're going to the same family of wallets over a period of time? Do you have some way of trying to catch someone who's trying to exploit that threshold? So it really has to be a review of your business and the way that you engage with your customers, and then try to make sure that you're covering all the risks there.
I second that.
Thanks very much.
Clients select on
Yeah,
this.
no, please.
And the landscape is pretty small. Like Marian said, you can kind of look and see the players. I would look for sort of length of experience in the space is one factor for sure. Also get into demos. You know, this is easier than choosing CRM software, or maybe not, but they will do a demo for you, right? You'll be able to spend time with potentially like an implementation team, get a feel for them. Support is going to be important for these tools, because we kind of raised this idea before about, okay, the tool is really awesome, right? They can show you that it does all these things. It monitors wallets. It does visualizations of things. You know, you can track and save transactions. You can do many things, right? So the feature set can be wide, but then how are you going to use the feature set? Do you have capabilities internally to use that feature set? And so support is going to be important, right? The training. And I know that a lot of these providers work on that, right? And will offer you significant training and spend time with your teams. So that's critical. But maybe, Amit, can I go back real quick to one point too? Because you asked about this sort of, what do we do to sort of do good things for our industry or create good reputation?
Please.
One way I think of this real quick is just around contextualizing all of this. And I think, as Marian said, the bright, shiny thing gets a lot of attention. I think that's true. And regulators are worried, right, about what's going on right now. We've got a couple of things we haven't even really touched on, which are kind of really fast moving in this space, are what's happening with DeFi. The May 2019 FinCEN interpretive guidance was mentioned, sort of a positive move. I'm not sure I would agree with that exactly. Got to be somewhat contrarian here, because I think that that's actually a rule that looks at regulating DeFi developers and dApps, and potentially even node operators as money transmitters, or even individuals that participate in the use of a DeFi protocol as a money transmitter. So this is whack-a-mole. That doesn't make a lot of sense to me. I think there's some solutions for those things that kind of find the middle road, where we're talking about, the ability to sort of foster financial privacy and sort of individual liberty, and also have sort of protection. But my context here is, if I look at I think the last report, the National Money Laundering Risk Assessment produced by the Treasury and FinCEN, was something like $300 billion laundered in the US annually, right, through the traditional financial system. Chainalysis, through their good reporting and research, 2019, they said 2.8 billion was laundered through crypto exchanges specifically. So those are different numbers in different times. So, but let's just say that even if it were, say, money laundering has gone down in the traditional financial system or up, it doesn't matter. We're still talking about what, 1 to 5% of what is laundered using US dollars. So, are we thinking about, as an industry, self-regulatory measures that are applying existing standards that may not be working that well? I mean, let's be honest, right? SARs are flooded into the Treasury. Are they properly responded to? Like, I don't know. I think there's legitimate questions around that. So as an industry, can we do self-regulatory measures, participation in groups like this, creation of guidance and standards in groups like this are critically important to that, because I think what we're looking at is really a small drop in the bucket. Do I think it's going to be big, and do I think it needs the right level of oversight? Yes. But to put a wet blanket on it this early on simply puts us in a really poor position competitively to be, a place where we can foster innovation around financial services. And so, I don't know if, I think we're probably over time, so I'll stop there. But if there's time, I think we should talk just briefly about this Treasury rule and how the Treasury would approach, self-hosted wallets, as they call them, without, really significant or maybe any participation from industry or voice from industry or public comment, and what that sort of means, what that approach signifies, or that posture signifies, let's say.
Yeah, no, absolutely. And I mean, let me broaden it, although I'll ask the panelists to get as granular as they would like, just in the broader pivot, because I think in addition to the specific rules that have come out of Treasury, whether it's unhosted wallets, the reduction in the threshold of the travel rule, et cetera, the Stable Act, which is being proposed as well, there are significant implications too, and I think more and more of you all have said it, the train has left the station and the sector's growing. And it's also providing actually some tremendous opportunities, and you can see these real use cases for driving financial inclusion, right? So emerging markets, frontier markets, some under sanctions, some under capital controls, others under tremendous monetary and fiscal challenges, inflation rates and the like, where folks, have 88, 90+% mobile phone penetration rates, can get a wallet, can get an application, and voila, you can store value, you can issue value, you can transfer value in digital ways. That has tremendous boon for financial inclusion. But there continues to be that sort of binary choice in the marketplace of let's ensure a compliant and robust illicit finance protection regime or inclusion. But the trend I would argue is shifting, right? And the FATF in the last couple of years has increasingly looked at effectiveness of an AML regime. I and a number of folks would argue that effectiveness must consider the level of inclusion, right? So if we have an AML regime in a jurisdiction or within a particular institution that leads to greater exclusion, greater de-risking, are we really being effective? And is that AML regime truly reasonable and effective using the nomenclature of the statute, right? So it's so as we think about the issues around financial inclusion, what are those opportunities that can be exacerbated? And to Jesse's point earlier, from an AML and KYC perspective, what are the explicit challenges there that need to be still overcome to get greater and wider adoption within these new financial technologies and within crypto in particular? Maybe I'll ask Jesse first to jump in there.
Sure. So, in relation to self-hosted, unhosted, what may or may not come out of the Treasury, we're Switzerland in that we support the regulators, law enforcement, government, and we also support the private sector. So I'll be measured in my response. But I think it's important to note, when you reference the volumes that we've identified, and when you reference the volumes that the Treasury had identified in traditional financial services, the issue in crypto is that I mentioned that we're following on-chain flows in the controlled environment. But that does not include the informal activity that happens via peer-to-peer. And we're not talking about peer-to-peer services that have compliance procedures and offer their own platforms. We're talking about informal systems, right? Using social media and other means, right, for direct peer-to-peer interaction. We know definitively that there are large volumes involved in those peer-to-peer markets in certain places, like jurisdictions that have crisis economies, right? Developing economies, some of the places that really need financial inclusion and access to better fiat currencies in many cases, right? But on the flip side, when we talk about that 300 million in traditional financial services, they cannot account for the fact that people may be exchanging cash between each other or gold bars or whatever else. So just because you have a visibility potentially into cryptocurrency, why would you put that more onerous regulation on it when you're not doing it in traditional financial services, right?
100% agree.
It will inhibit to some degree. My recommendation would be, because of what you can do with the forensics and what you can follow on-chain, we need to pivot into a place that's more behavioral analysis, right? You can identify potentially risky activity from things like typologies and other kinds of intelligence that you can gather. That's what should be targeted. And with crypto, you can arrest those things in real time, right? You can even do things like identify indirect exposure, right? Meaning if you have some kind of activity occurring like comparatively smurfing in traditional financial services, you're still going to be able to identify that down the line and arrest it. So that's what we're starting to encourage, is to look at it in a way that adopts and uses this technology and the forensics you can do to your advantage, while not inhibiting the consumers and the space itself.
Excellent. Marion, Noah, any thoughts additionally there on my question or response to Jesse's description as well?
Well, I fully agree there should be some consistency between how the blockchain-based transactions are regulated in the traditional financial spaces. And it's probably just because I've been on the traditional side for so long, I always try to equate it when I'm looking at a business, when I'm looking at various activities. But I'll also say what will sound like a cop-out. If a company comes to us and wants to establish a banking relationship, I, again, am going to rely on them to understand their business. And if they're interacting globally in a market that some of these more non-traditional transactions might be taking place, then my question is going to be to ask them to fully explain how they're managing that risk, because the risk is only ours indirectly. And so as long as if you're trying to innovate, you're trying to serve an underserved market, you're going into a place that's been traditionally challenging in the past. If you've come up with an innovative way to do that, and you can explain how you're complying with the regulations that you're responsible for on this side of the ocean, and how you're covering all of those exposures, if you've thought it through and come up with a way to do that, then I personally, I can't say the bank, will be flexible in viewing that, because that's your business. So that's your baby. That's, it's your job to come up with those solutions. And if you feel you've covered everything, we're going to be receptive to that. And I would hope that any financial institution would be, anybody looking at that and looking at the risks.
Yeah, I think separate sort of point, but to your point on inclusion, I'm still grappling with this idea a little bit, frankly. I think first off, there's kind of an interesting paradox, right? Like we say, crypto has this, capability to be more financially inclusive, right? So really easily accessible. I think that's sort of true and not, right? I mean, crypto has had a sort of user experience, user interface problem for a long time. I think that's starting to solve itself. Exchanges are becoming a little less daunting to use. Wallet, is becoming a little bit more mobile, a little bit more secure. So that's good advancement. I guess the other part here is that in some ways, I mean, crypto is built on existing financial infrastructure in some ways, right? I mean, it was an experiment of its own, but in order to get onto the highway, to have on-ramps and off-ramps to fiat, it relies on traditional banking. And so, in some ways, this is a question for, AML, not just for the service provider, for the VASP, but for the underlying financial institution, in my mind. There's a bank on every sort of Main Street corner. So when I think about financial inclusion, just in general financial services, I think, why are people unbanked or underbanked? We can't go into all that right now. But I think there are things that can be done just in traditional banking alone that can open, access to effectively low risk accounts, right? In crypto, if you add crypto on top of that, I think that it's almost a flow down, right? Because if you're a VASP, you have, a regulated banking partner who, has compliance requirements that are then put on the VASP, and so it's a flow down of the compliance requirements. So it's like, why are we starting with crypto in one way? It's kind of trying to swim upstream, I guess. Again, these are not fully formulated thoughts, didn't prepare these as talking points, but they're things that I've been kind of grappling with, that we seem to be starting at the wrong end here.
Yeah, no, I think you make some very valid points here, Noah. One is the square peg round hole challenge, right? So we have a history and decades-long practice around anti-money laundering, financial crimes compliance controls that have evolved over time to fit the fiat-based financial intermediary model. And so now, how do we evolve regulatorily, technologically, to increasingly peer-to-peer, increasingly non-fiat, and increasingly cross-border, non-intermediary models, right? And so there's a square peg round hole problem. And the second point, that is really value added to the discussion is, and really curious about you guys thinking is, are we in the longer term moving to a more decentralized financial services landscape, given the cross-border nature, given the advent of new technology, and as Jesse pointed out, given the advent of organizations never before conceived of as financial services organizations, realizing the breadth and depth of their network allows for them to get into financial services, social media companies, e-commerce platforms, and the like. And so in some way, to be completely overly simplistic, it's really the tokenization of value that can then be provided issued, stored, and transferred between different counterparties in different networks. And voila, you've got other financial systems now upon you. Noah, you rightly put out a third piece, right, which is on-off ramps, right? And so what is the role of those on-off ramps? Are they the sole obliged parties to conduct the requisite KYC, KYB, tracking, analytics, monitoring, or should it be with these new technology companies as well? And there's obviously arguments for and against. And so, if I could just ask the group, as you know, as we close here, and there's a couple questions in the comments from our participants, is what is the next 2, 5, 10 years? Is it more decentralized in your opinion, less decentralized? And what's your kind of crystal ball futurist point on and perspective on the regulatory modernization given that? So in sum, are we moving toward more decentralization or to more centralized? And secondly, how are you thinking about the evolution of this space in the next 2 to 5 years? Start with Jesse.
That's a great question. I mean, I think obviously what we're seeing, right, is that all of the decentralized tech that we're seeing rise is coming from initially what was built based on the blockchain technology. So my assumption is we go further in that direction. At the same time, I will say that regulators, there's just no environment where there will not be any controls, right? And where they will not need the capabilities when bad things happen to be able to go after that activity. And so, you know, the issue with DeFi in a nutshell at a very basic level is nobody is left holding the bag when bad things happen, right? And so that is something that's going to have to be worked out. And I don't know how you do that, because full disclosure here, when I try and wrap my brain around DeFi, my understanding is probably that of like an 8-year-old, which is still better than most, if we're being honest. But, you know, in relation to the industry, I think what I see that is interesting / exciting is, you know, crypto is still currently by and large used as an investment, and we're just seeing the growth there, right? But when it is used for payment, right, and procurement and services, that's when it becomes far more exciting. That's when we're able to really start talking about the things that you're talking about, Amit, like financial inclusion and distribution and access. And, you know, that's the real game changer. I think generally we are going in the direction of digital payments, right? Things are rapidly evolving around that. Also, to your point, you're seeing big vendors getting into financial services themselves also, right? So we're moving in that direction regardless. And the question is going to be how you marry all of those things successfully while maintaining that financial integrity that you have to have globally.
Thanks, Jesse. Marianne, a couple last comments?
Yeah, I would definitely agree. That's the direction we're headed. But I think to your point, Jesse, there has to be the ability to trust. If I'm going to operate all of my financial activity in a DeFi space, then I have to be able to trust either that the system has absolute integrity or that there's someone who I can contact if something goes wrong. And I don't think we're there. That and I also agree with the cultural tipping point where cryptocurrencies go from investment to tender, where they're used in day-to-day transactions. And there have been a couple of false starts in that direction, but both because of the value of the currency itself and the volatility in the market, it hasn't quite gotten there.
Awesome.
An
Thanks,
object
Noah.
in motion will tend to stay in motion unless another force is acted upon it.
There you go.
And that has been true for Bitcoin. It's been true for programmable money. It will be true for the application of programmable money in lending and in token swaps, DeFi. It's inexorable. It will happen. There will be, I believe, honestly, an alternative financial system can be built where the regulator has a very difficult time reaching these things. But I think Jesse's absolutely right around qualifying it's really about the activity, right? Not necessarily always the identity, but yes, it's going that direction.
Awesome. Thank you guys. And A very, very robust conversation here. A lot of tools, a lot of expertise, and a lot of perspectives. They're super helpful. I agree with you folks that the innovation will continue. The train has left that station and will only kind of grow in momentum. I do believe that as we see more use cases, both from a driving of products and services and inclusion, as well as the attributes of some of that technology to aid in risk and compliance and governance controls, that marriage, I think, just needs to be a bit more emphatic. And hats off to the industry, I think, to do that. The work of the Global DCA is a testament to that insofar as, providing guidance both to the sector, but also, as a helpful hand and friend to the regulatory and policy community. The work that we're doing with the compliance and inclusive finance working group on the rulebook, invite folks to come participate there as well. You can find more on FinClusive.com. The work that Chainalysis has been doing on analytics in particular, and they're involved in a number of fora, including the chamber and otherwise, and invite you to really look at some of the work there, and of course the perspectives that Marion has provided from the bank side and from NOAA. So I just want to thank the panelists for their time and expertise here, and I would like to thank Global DCA for giving us the opportunity to have this conversation. And I'll hand it over to Matt.
Thanks, Amit. I want to thank our keynote speaker this morning, Erik Kiefel from FinCEN. And again, I want to thank Amit Sharma, as well as our panelists, Marion Todd, Jesse Spiro, and Noah Buxton. A special thanks to our board members, Gabby Coos and Renata Shkoda, who put their own time and effort into putting this webinar on. And thank you to Catherine Orfanos for her technical help. As everybody has mentioned, and I will reiterate, this marketplace is becoming more relevant and important. And as that happens, the regulatory target on firms in this space, especially regulated firms, becomes much bigger. And these are challenging issues. Most of the rules and standards and best practices were formulated pre-digital assets and blockchain technology formation. Formally and legally, little has changed, however, to adapt to this new technology and marketplace. But at root is always the same requirement. You need to know your customer and where their funds come from. And that can be challenging to prove without the new tools that are being developed. In closing, I want to emphasize a couple of things about the GDCA. The GDCA is a startup organization which depends on the volunteers and their efforts. In the last year, we have been working, I would estimate the time and effort given for this organization and its development to be around $3 million and counting. What we are seeking to do in a nutshell with this organization is develop standards for the digital assets industry and to support enforcement of those standards. The GDCA will be taking membership applications shortly. Please contact us from our website if you are interested in joining. Finally, we are developing our organization and have achieved a great deal in a short period of time. We've developed governance of the organization, formally incorporated the organization, officially launched the organization, and have galvanized the group's efforts to spur support and membership development. The ultimate success of this organization will depend on the input of its membership. We need money to operate, certainly. But more importantly, we need people willing to step up and provide their expertise, which will allow us to be the thought leaders in this space as we develop standards on a consensus basis that facilitate the health of this burgeoning industry. Thank you, everybody who attended. We very much appreciate the fact that you've taken the time out of your day to tune in and listen to this terrific panel. So I'm going to sign off at this point. Gabby, why don't you take over?
Thank you. It's a pleasure to have hosted you all today. As mentioned by Matt, we very much look forward to continuing discussion with our amazing audience and panelists. Video of today's event, as this event was recorded, it will be available on the globaldca.org website. And additionally, up on YouTube, I will be posting that to our company LinkedIn page shortly. Again, thank you very much. This concludes today's event. Please have a pleasant rest of your day and a happy 2021. Thank you.